Hi, I'm Kara Murphy, and this is Money with Murphy. American companies are growing earnings at their fastest pace in years. Yet, as we move through the second quarter earnings season, investors are increasingly focused on the cost of generating that growth. Companies in the S&P 500 index are currently on track to grow earnings by 40% year over year. That's the strongest pace since 2021. More than 86% of S&P 500 companies that have reported so far have exceeded earnings expectations. And meanwhile, the aggregate profit margin in the S&P is roughly 16%. That's the highest level since 2009. This growth, importantly, is broad-based. 10 of the 11 sectors in the S&P are currently reporting year-over-year earnings growth, with particular strength in technology, energy, and financial sectors. Even industrial companies have reported healthy demand trends. Healthcare, on the other hand, is the only sector currently where earnings are declining. The most important commentary may be coming from the banks. Financial companies have been one of the largest contributors to revenue growth this quarter, but importantly, they also provide a very clear, real-time read on the economy. Through consumer spending, borrowing activity, credit card payments, loan performance, banks often see changes in household behavior before they show up in economic data. According to those executives, the consumer remains resilient despite elevated interest rates and tariff uncertainty and higher oil prices. For now, the banking sector continues to describe households as in good shape, a result that has surprised many investors given the challenges they have faced over the past year. If banks are telling the story of a resilient consumer, technology is telling the story of continued AI investment. The tech sector is currently reporting earnings growth of roughly 65%, with semiconductor companies leading the charge. Earnings in the semi industry are up more than 130% year over year, reflecting continued demand tied to artificial infrastructure, data centers, and computing capacity. Not every company, though, is enjoying economic tailwinds. Airlines, for example, have been among the industries most affected by higher fuel costs. Several companies reported pressure on profitability, reduced profit forecasts, scaled back growth plans, or even withdrew guidance altogether. So with booming earnings and record high profit margins, what are investors worried about? Well, free cash flow. One company investing heavily in the AI build-out reported phenomenal earnings last week, but also reported negative free cash flow. Despite the strong earnings report, the stock traded lower. That reaction highlights a really important shift in the market. Investors are no longer focused solely on AI's potential. They're increasingly evaluating the cost of building out that infrastructure and the returns those investments may ultimately generate. So what's the takeaway for investors? The earnings picture remains remarkably strong. That said, investors are beginning to look beyond the headline numbers. They're asking, rightly, whether the extraordinary amount of capital being invested in artificial intelligence today will generate the earnings needed to justify those investments. That's a debate that will likely play out over years. For now, however, strong earnings, healthy profit margins, and broad participation across sectors suggest the underlying foundation of this market rally remains intact. As always, invest wisely and live richly.